And I know it sounds kind of crazy, like why would you want to trade a stable coin, right? Because there's no volatility. Well, this is what I thought until we started running like back tests on all the stable coins in the crypto universe. And what we found is that we actually are getting really stable results on stable coins, but only some of them. And so what I'm trying to do today is just get rid of the ones that are too stable for us to perform and trying to identify the ones that I guess are super volatile. I'm going to classify them into a basket, right? And then once I've identified these algorithmic stablecoins with volatility, I'm going to send this to my quant team, and then they're going to create specific strategies to exploit the inefficiencies of these stablecoins. When you take USDC, right, USDC, USDT, well, they're pegged to the dollar. So basically, in times of extreme volatility, like let's say in 2022, when the market crashed 80%, you would have maybe a depeg of stable coins like USDC and USDT. It would last for a minute or maybe 5 minutes max. Then you have another basket of what we call algorithmic stablecoin, which basically like there's no human behind it. So it's literally just an algorithm that's trying to do its thing and stabilize the peg. And so yeah, sometimes these coins can really show insane opportunities.
Not all stable coins are created equal.
No, they're not. Exactly. Yeah. So this is why, for example, like personally, I don't really see the point of, I feel like it's an experiment, the algorithmic stablecoin. They are experiments. Nobody uses them, like barely anyone. And they kind of end up being a shitcoin, with insane volatility. And so because their algorithm is designed to try to bring the price up when the prices goes down, right? So it makes it extremely good when you have a trading model that's based on mean reversion, right? Because basically, let's say the price is stretching down too much, then this algorithm, literally its only job is to inject liquidity that it has, like that it keeps in reserve, to inject liquidity back into this asset, the underlying asset, and then it's going to bring it back to the mean, right? So the price will go back up, right? And it's the same with stocks and all that stuff, right? And in this entire world, basically, of finance. And this is why mean reversion, you have the most edge in a mean reversion model. There's a little bit of edge, but not too much. Trend following, a little bit of edge, but you're going to take tons of losses, and then you're going to have this like one winner that's going to stand out. But mean reversion is way more stable. Like it works basically all the time. Like every day you're going to print money. Sometimes you're going to have like losers, but especially if you diversified across a wide array of assets, you will eventually win.